3 weeks ago, I was sitting in a Chase branch waiting to talk to someone about a wire transfer, and I noticed something. The guy 2 seats down from me, older, nice watch, no laptop bag, just a leather folder, got up after about 4 minutes. A woman in a blazer came out to meet him at the door. Not at a teller window, at the door. She shook his hand, walked him to a private office in the back, the kind with a door that closes. I waited 23 minutes for a teller. Same bank, same building, same Tuesday afternoon. I went home and started doing the math on what separates my experience from his. And what I found was not just about banking. It was a complete map of how American financial life actually works, broken into 5 distinct classes, each with a different set of rules, a different cost of money, and a different ceiling on what's possible. Most people think financial class is about income, how much you earn. It's not. It's about net worth, what you own minus what you owe. And that number, not your salary, determines which version of the financial system you're operating in, which rules apply to you, how expensive your debt is, whether the system is helping you build or quietly draining you. Today, I'm going to show you exactly where you are, not to make you feel good or bad about it, to give you a map, because you cannot navigate a system you can't see. My name is Marcus, and I spend a lot of time thinking about the mechanics behind financial systems, who they're actually designed for, what the real thresholds are, and what changes when you cross them. Quick note before we get into it. Nothing in this video is financial advice. This is purely educational. I'm here to break down the data so you can think more clearly about your own situation. Before we get to the 5 classes, I need to establish something that most people fundamentally misunderstand. Net worth is not your salary. It's not your income. It's the number you get when you add up everything you own. Savings, investments, home equity, retirement accounts, the car, and subtract everything you owe. Credit card debt, student loans, car loan balance, mortgage balance. What's left is your net worth. And net worth is the number that determines your class, not your paycheck. This distinction matters enormously because the American financial system is built on a specific assumption. People with higher net worth are lower risk. And lower risk means better terms on everything. Lower interest rates, lower fees, access to products that don't even exist for everyone else. The rewards compound upward. The penalties compound downward. Here's where Americans actually stand right now, by the numbers. The median American household net worth is $192,700. That sounds like a lot until you realize the mean, the average, is $1,059,470. The gap between median and mean tells you the whole story. A relatively small number of households with very high net worth are pulling the average up dramatically, while the majority of households sit at or below the median. The bottom 50% of American households hold just 2.5% of total household wealth. The top 10% hold 67%. The top 1% hold 30.6%. These are not abstract statistics. They map directly onto 5 distinct classes of financial experience, and you are in one of them right now. 40% of American households have a net worth under $10,000. Many have negative net worth, more debt than assets. If you're here, the financial system is not serving you. It is processing you. The median transaction that triggers a bank overdraft fee is $24, not $240, $24. A lunch purchase, a streaming charge, a small bill that hit before the paycheck cleared. The fee, $35. Sometimes multiple fees in the same day. Banks collected $12.1 billion in overdraft fees in 2024 alone, and here's the number that should stop you cold. 80% of that $12.1 billion came from just 9% of customers. These are not reckless spenders. These are people living close enough to the edge that a single $24 transaction at the wrong moment costs them $35. A 3-day overdraft on a $24 purchase works out to an effective annual percentage rate of over 16,000%. That is not a typo. The payday loan industry charges 391% APR. Banks charge more. Being unbanked costs approximately $3,000 per year in check cashing fees, prepaid card fees, and money orders. Over 30 years, that's $90,000 in direct fees and $300,000 in lost wealth if that money had been invested instead. $390,000 total. The poverty tax is a specific calculable number. Auto loans at this level, 15% to 21% APR on used cars. Someone with strong credit pays 5% to 7%. On a $30,000 car, that's the difference between $4,000 and $13,000 in total interest. A $9,000 penalty for being in Class 1. In 43 states, auto insurance companies can use credit score as a pricing factor. Someone with a 580 credit score pays on average $432 more per year for the same coverage than someone with a 740 score. The annual cost of being in Class 1 with a $60,000 income, roughly $2,466 in extra fees and higher rates. Over 30 years with investment opportunity cost, $407,000 in lost wealth. Same income, different class. The system doesn't just fail to help you escape, it actively charges you for staying. This is where most Americans aspire to be, and it is genuinely better than Class 1 in ways that are concrete and measurable. The single most important thing that happens when you cross $10,000 is that you have a cushion, and a cushion changes every financial interaction you have. Without a cushion, every unexpected expense is a crisis. With a $10,000 cushion, the same events become problems instead of emergencies. The car repair gets paid from savings, replenished over months. The job loss gives you runway to find something better rather than something available. Princeton research documented that financial scarcity creates cognitive impairment equivalent to a 13-point IQ from the mental bandwidth consumed by constant financial calculation. That bandwidth gets restored when you have slack, when the background calculation quiets down enough to think about something else. The credit score impact is also real. Below $10,000 in net worth, scores typically cluster in the 580 to 650 range. Above $10,000, scores generally reach 680 to 720. That 60 to 70 point difference translates to interest rates on every loan, apartment approvals, and insurance costs. At around $20,000 to $50,000 in net worth, premium banking tiers appear. Bank of America Preferred Rewards starts at $20,000. 25% bonus on credit card rewards, fee waivers. At $50,000, the bonus rises to 50%. Real benefits. But here's the catch. To access them, you have to park the qualifying balance at the bank, which pays 0.01% APY, while high-yield online savings accounts currently pay 4.5% to 5.0%. Keeping $50,000 at Bank of America costs $2,000 per year in foregone interest, often more than the rewards are worth. The credit card rewards game also works differently here. Federal Reserve research found $15 billion moves annually from low-score households to high-score households through the reward system. People above 780 earn $950 per year in rewards, pay minimal interest. People with subprime scores earn $180 in rewards, but pay $640 more in interest. If you're carrying a balance and collecting rewards, you are losing this game. The median American household net worth is $192,700. This is, by definition, where the middle sits. Class 3 is less a destination than a transition. You're still playing on the public financial field, but the options are expanding. The leverage is shifting in your direction. Credit score at this level typically reaches 720 to 760. That range unlocks the best rates on conventional mortgages and auto loans. It makes the rewards game genuinely profitable for the first time because you're paying your balance in full and capturing the rewards without the interest drag. The most important financial change at this level is the ability to use debt strategically instead of defensively. In Class 1 and 2, debt happens to you. In Class 3, debt can become a tool, a mortgage that builds equity, a refinance that saves tens of thousands, a HELOC at 7% to 8% funding and investment returning 10% to 12%. The Federal Reserve's survey of consumer finances shows median homeowner net worth of approximately $396,000 versus $10,400 for the median renter. Home ownership isn't the only path, but the equity accumulation and inflation hedge it provides is real and significant. The tension in Class 3 is between consumption and accumulation. The household earning $120,000 and spending $115,000 builds $5,000 in wealth per year. The household earning $85,000 and spending $65,000 builds $20,000. The first looks more successful. The second is becoming more successful. The question that defines Class 3: when income rises, does the savings rate rise, stay flat, or fall? This is where the rules change. Not dramatically, not overnight, but structurally. The first change is psychological. Above $500,000, no plausible single event is catastrophic. The car breaks down, the medical bill comes, the job gets lost. None of these are good. All of them are financially survivable. That shift in the floor changes every decision you make. The second change is borrowing costs. Mortgage rates. With excellent credit and a large down payment, come in at the absolute bottom of available ranges. A 0.5% to 1% rate difference on a $500,000 mortgage over 30 years is $85,000 to $175,000. The third change is investment access. Above $200,000 in annual income or $1 million in net worth, you become an SEC accredited investor. This is one of the most consequential thresholds in American financial life, and almost no one outside of finance knows it exists. Accredited investor status unlocks hedge funds, private equity, venture capital, and pre-IPO opportunities. The average company now stays private for 10.7 years before going public, versus 6.9 years in the 2000s. The largest returns on the most successful companies are captured in private markets. By the time regular investors can buy in an IPO, 70% to 80% of the total return has already been captured. Only 14.8% of American households qualify as accredited investors. Those households control 78.7% of all private wealth. Not primarily because they worked harder, so because they have access to a different set of financial instruments that are legally closed to the other 85%. At $3 million, you don't have a banker. You have a team. Not a team that calls when a promotional rate is available. A team that proactively manages your banking relationship, tax exposure, estate planning, and investment allocation. At $10 million, the minimum for JP Morgan Private Bank, Goldman Sachs, Private Wealth, and Bank of America. Private bank specialists in each area coordinate on your specific situation. The most important product at this level is securities-based lending. You have $5 million in a portfolio. You need $1 million in cash. Instead of selling, which triggers capital gains taxes, you borrow against the portfolio at 4% to 6% interest. The portfolio stays invested. No taxes triggered. Cash in hand. The total market for securities-based lending, $138 billion. The rate, 4% to 6%. Personal loan rate for Class 2, 9% to 11%. Credit card rate for Class 1, 21% to 30%. The wealthy borrow at half the rate of the middle class and 1/5 the rate of the poor. This enables the strategy tax attorneys call buy, borrow, die, buy appreciating assets. Never sell. Selling triggers taxes. Borrow against the assets at low rates to fund your life. When you die, your heirs inherit at a stepped-up basis. All capital gains accumulated during your lifetime are legally erased at death. They sell immediately with zero capital gains tax. You lived off borrowed money, never paid taxes on appreciation, and your heirs inherit everything clean. This is not a loophole. This is the system functioning exactly as Congress designed it. The estate tax applies to estates above $13.6 million per individual in 2024. 99.9% of American estates owe nothing. The 0.1% that do have access to legal structures, grantor-retained annuity trusts, family limited partnerships that further reduce or eliminate the exposure. For Class 5, the financial system is not neutral. It is actively generative. Every year, the gap between Class 5 and every other class grows, not primarily from earned income, but from the structural advantages of being in Class 5 in the first place. This is not a detour. This is the heart of understanding how the class system actually perpetuates itself. The median net worth for white American families, $285,000, Class 4 territory. For Asian American families, $536,000, all solidly Class 4. For Hispanic families, $61,600. Upper Class 2 to Lower Class 3. For Black families, $44,900, Class 2. The median Black household has approximately 16% of the wealth of the median white household. This maps with near-perfect precision onto banking access. About 20% of white households have reached millionaire status and access private banking tiers. For Black households, 5%. At the other end, 10.6% of Black households remain entirely unbanked, compared to 1.9% of white households, a factor of more than 5. Between 2019 and 2022, Black median wealth rose 61%. White median wealth rose 31%. That sounds like convergence, but because the starting points were so different, the absolute dollar gap actually increased by $50,000. The ratio improved. The actual disparity got worse. White families currently hold 84% of total U.S. household wealth while comprising 66% of households. Black families hold 3.4% of total wealth while comprising 11.4% of households. The class system is not colorblind. The historical mechanisms that assigned class, lining, discriminatory lending, exclusion from GI Bill benefits are not operating today in the same forms, but their consequences are. Wealth compounds. The class you were born into shapes the class you can reach, and the starting points were not equal. Two people, identical $60,000 annual incomes. One has $25,000 in savings and a 740 credit score. Low, Class 3. One has $800 in savings and a 610 score. Class 1. The Class 1 person pays annually $210 in overdraft fees, $144 in account maintenance fees, $1,500 extra on the auto loan interest, $120 extra in credit card interest, $60 in out-of-network ATM fees, $432 extra in auto insurance due to credit score pricing. Total annual cost of being in Class 1 with a $60,000 income, roughly $2,466. Over 30 years, $73,980 in direct costs. With investment opportunity cost, $407,000 in lost wealth. Same income, $407,000 different outcome, purely from which class you occupy. The Class 3 person builds credit, qualifies for rewards cards that pay rather than cost, accesses banking tiers with fee waivers and rate discounts. The Class 1 person pays fees that make building the cushion needed to escape Class 1 harder. It is a trap, and it is structured as a service. Here is the honest truth about the 5 classes. Most people overestimate their class based on income and underestimate it based on net worth. A household earning $150,000 with $30,000 in credit card debt, a car loan, and no significant savings has a net worth that puts them in Class 2, despite an income that looks like Class 4. Income feels like class. Net worth is class. The moves that actually change your class are not complicated. They are just slow. Pay off high-interest debt first. Every dollar of credit card debt you eliminate is a guaranteed 21% return. Nothing in the market matches that. Build 3 months of expenses in a high-yield savings account before investing anything beyond a 401k match. The cushion is not just financial protection. It is cognitive protection. It restores the mental bandwidth that financial scarcity was consuming. The 401k employer match is a 100% guaranteed return. If you are not capturing the full match, that is the first thing to fix. After those steps, invest consistently in a low-cost index fund. $500 a month at 10% historical annual returns over 30 years becomes $1.13 million. Not from Class 5 advantages, not from accredited investor access, from time and consistency in the public market available to everyone. The difference between Class 1 and Class 3 over a working lifetime is not primarily income. It is the presence or absence of the cushion, the credit score it enables, and the compound avoidance of the fees and higher rates that drain Class 1 wealth year after year. That guy in the Chase branch with the leather folder and the private office, he wasn't there because he worked harder than the 23 people waiting for tellers. He was there because he crossed a threshold that unlocked a different relationship with the financial system. The thresholds are real. The differences are real. The lifetime wealth impact of which class you're in, not which class you feel like, which class your net worth puts you in, is measured in hundreds of thousands of dollars. Class 1 pays the fees that fund the free checking accounts in Class 5. Class 2 thinks they're getting rewards while subsidizing the Class 5 VIP experience. Class 5 borrows at 4%, builds wealth tax-free, and passes it to their heirs with the capital gains legally erased. Once you see the map clearly, you can stop making decisions based on the way the system presents itself and start making decisions based on the way the system actually works. Calculate your real net worth tonight. Assets minus liabilities. See which class you're actually in. Then decide, deliberately, with full information, what it would take to move. Not because the class you're in says something about your worth as a person. It doesn't. But because the class you're in determines which rules apply to you. And knowing the rules is the only way to change them. If this video gave you a clearer map of where you actually stand, hit that like button and subscribe because this is what I do every week. Drop a comment and tell me, which class are you in right now? And where are you trying to get? I read every single one. See you in the next one.